Ever wish you had like a crystal ball to predict stock prices?
Hmm.
Well, today's deep dive is all about exploring that idea.
Okay.
The idea that maybe, just maybe, stock prices perfectly reflect all available information.
Interesting.
It's called the efficient capital markets hypothesis.
Yeah.
And we're going to unpack a landmark 1991 paper by Eugene Fama to see what it really means for you and me as we navigate the market.
It's a fascinating concept. And Fama's paper, Efficient Capital Markets,
Yeah.
is a must-read for anyone who wants to understand how markets work.
So tell me, what does Fama actually mean when he talks about market efficiency?
At its core, market efficiency suggests that the price of a security like a stock reflects all available information relevant to its value.
Mm-hmm.
Think of it like a giant puzzle where every piece of information from company earnings reports to whispers about a potential merger is already factored into the price you see.
Okay, that makes sense. But does that mean there's absolutely no way to find those hidden gems? Those undervalued stocks that could make you a fortune?
That's where things get interesting. Fama acknowledges that a truly strong version of market efficiency, where information and trading costs are zero, is practically impossible.
Yeah.
In the real world, we have to consider weaker versions where efficiency is limited by those real-world constraints.
So it's more like a spectrum of efficiency, not just a black and white concept.
Precisely.
Yeah.
And that brings us to a crucial point, the joint hypothesis problem.
Okay.
Fama argues that we can't test market efficiency in isolation. Any test we conduct also relies on assumptions about how prices should behave in the first place.
Right.
This makes it really tricky to prove absolute efficiency because we're always testing two things at once, how efficient the market is and how accurate our model of price behavior is.
That's a bit mind-bending. It's like trying to solve a riddle where the answer depends on another riddle you haven't figured out yet.
Yeah.
So even if we find something that seems like a violation of market efficiency, it could just be that our model for predicting prices is off.
Exactly. You're getting it. And this is incredibly important for you as an investor.
Yeah.
It means you should always approach claims of market inefficiency with a healthy dose of skepticism.
Okay, so we can't just assume markets are perfectly efficient, but we also can't rule it out completely.
Right.
What does all of this mean for our ability to predict stock returns?
Well, if markets are truly efficient, you wouldn't expect to find any predictable patterns in stock returns, right?
Right.
All that information should already be baked into the price.
Yeah.
But early studies, including some of Fama's own work back in 1965, found a tiny bit of predictability in daily and weekly returns, particularly this thing called positive autocorrelation.
Autocorrelation.
Yeah.
So today's price movement might give us a hint about tomorrow's price. Is that what you're saying?
In a very, very small way, yes.
Yeah.
Think of it like a slight echo in the market, but not something you could consistently profit from. And for a long time, the idea was that expected returns were basically constant.
Yeah.
But as researchers got their hands on larger data sets, like in the 1988 work of Lowe and McKinley, they started to see a bit more predictability, especially when looking at portfolios of small stocks.
Interesting. So maybe size does matter in the market after all? But you're saying this predictability is still a small part of the overall picture?
That's right.
Yeah.
It's not like you could reliably beat the market just by looking at past price movements.
Okay.
And then things got even more complex when researchers started looking at long-term returns.
Okay.
In 1986, Shiller and Summers dropped a bit of a bombshell, suggesting that stock prices could deviate significantly from their fundamental values over long periods.
So you're saying that in the long run, prices might swing wildly, even if they're somewhat efficient in the short term?
Yeah.
That's a pretty big challenge to the idea of efficient markets.
Absolutely. Fama and French investigated this further in 1988 and did find some support for this long-term predictability. But there's a catch. It turned out that this predictability was heavily influenced by the extraordinary market conditions during the Great Depression,
Right.
which was a once-in-a-century event.
So are we seeing irrational market bubbles in these long-term swings?
Right.
Or are expected returns actually changing for rational reasons?
Yeah.
How do we tell the difference?
That's the million-dollar question, isn't it? It's one of the biggest debates in finance,
Right.
and we'll explore it further as we continue our deep dive. But before we get there, let's look at another intriguing piece of the puzzle, the role of dividend yields in predicting returns.
Dividend yields? You mean how much a company pays out in dividends relative to its stock price?
Yes.
Isn't that supposed to be irrelevant according to classic finance theory?
You'd think so, wouldn't you?
Yeah.
But in 1988, Fama and French found that dividend yields could actually predict returns, especially over a 2 to 4 year horizon.
Okay.
Again, it raises the question, are markets inefficient? Or are expected returns simply varying over time for reasons we don't fully understand?
Okay, now I'm really starting to see how complex this whole market efficiency thing is. It's not as simple as just assuming that prices always reflect all information.
Right.
There are all these nuances and potential exceptions.
You're getting it.
Yeah.
And to add another layer of complexity, it's not just about past returns and dividend yields. Fama and French discovered that the predictability they observed wasn't just limited to stocks. It extended to other types of securities as well.
So these patterns weren't just random market quirks.
Exactly. They argue that if variations in expected returns as predicted by dividend yields were common across different securities, it was likely tied to broader economic conditions.
Okay.
They even found connections between dividend yields, bond default spreads, and economic downturns.
So maybe investors are actually behaving rationally, adjusting their expectations based on broader economic signals?
Yeah.
That's a pretty compelling argument for market efficiency, isn't it?
It is, and it suggests that maybe the market is a bit smarter than we sometimes give it credit for.
Yeah.
But before we jump to any conclusions,
Right.
we need to acknowledge that even with these intriguing connections, there's always the possibility of spurious correlations and data dredging.
Right. Just because we see a pattern in the data doesn't necessarily mean it represents a real underlying relationship.
Exactly.
Okay.
It's like seeing shapes in the clouds.
Right.
We need to be careful not to overinterpret the data.
Yeah.
And speaking of potentially misleading patterns, our next stop on this deep dive will take us into the world of anomalies. Those instances where market behavior doesn't quite line up with our neat theories.
This is getting exciting. Let's dive into those anomalies and see what they can tell us about the true nature of markets. So you mentioned these anomalies that challenge our understanding of market efficiency. What are they and how do they shake things up?
Think of anomalies like cracks in the foundation of traditional finance models. They're instances where stock returns don't quite fit the predictions of classic theories.
Oh, I guess.
Like the Sharpe-Lintner-Black model. You remember we touched upon that earlier?
Yeah.
Well, this model suggests that a stock's return is primarily determined by its beta, which is a measure of how sensitive it is to overall market movements.
Right. So a stock with a high beta would be expected to have higher returns because it's riskier, right?
Yeah.
But you're saying these anomalies suggest there's more to the story.
Exactly. Researchers started finding factors beyond beta that seem to influence stock returns.
Okay.
One of the earliest and most perplexing discoveries was the size effect. In 1981, Rolf Banz found that smaller companies, even after accounting for their market risk, beta, tended to outperform larger companies.
That's pretty counterintuitive. You'd expect larger, more established companies to be less risky and therefore have lower returns, wouldn't you?
Right.
What could explain this size advantage?
That's the question that has puzzled researchers for decades.
Yeah.
Some argue that smaller companies are simply riskier in ways that traditional models don't capture, while others suggest it might be due to behavioral biases among investors. Whatever the explanation, the size effect was just the beginning.
So what other anomalies popped up to challenge the status quo?
Well, in 1977, Sanjoy Basu found that stocks with high earnings-to-price ratios tended to outperform. Then, in 1988, Laxmi Chandbhandari discovered that leverage the amount of debt a company uses also played a role in explaining returns.
So it's like the market was rewarding certain characteristics beyond just how much a stock moved with the overall market.
Yeah.
Characteristics like size, earnings relative to price, and even how much debt a company carried.
Precisely. And perhaps the most well-known anomaly, and the one that really shook things up, is the book-to-market effect, discovered by Fama and French in 1991.
Book to market. Can you remind me what that means again?
Of course. Imagine you're looking at a company's balance sheet. The book value is essentially the accounting value of the company's assets minus its liabilities.
Okay.
It's like taking inventory of everything the company owns and subtracting what it owes.
Right.
Now, the market value is what investors are currently willing to pay for the company's stock in the market. The book-to-market ratio is simply the book value divided by the market value.
Okay, I'm following so far.
Yeah.
So a high book-to-market ratio means the market is valuing the company lower than its accounting worth.
Exactly. Fama and French found that companies with high book-to-market ratios, often called value stocks,
Yeah.
tended to outperform those with low book-to-market ratios,
Oh, okay.
even after accounting for other factors like size and beta.
So are these value stocks like those hidden gems we talked about earlier, the ones that are somehow undervalued by the market?
That's the big question, isn't it?
Yeah.
Are these anomalies signs of genuine market inefficiency? Mispricings that savvy investors could exploit? Or are they simply telling us that our models of risk and return are too simplistic? It's that pesky joint hypothesis problem rearing its head again.
It seems like we're back to that fundamental question. Are markets efficient, or are there cracks in the system that we can take advantage of?
Right. And to make things even more intriguing, these anomalies often intertwined. Smaller companies, for example, tended to have higher leverage and higher book-to-market ratios.
So it's not just one factor in isolation. These anomalies seem to cluster together in interesting ways.
Precisely. And that raises even more questions about what these anomalies are truly capturing.
Yeah.
Are they reflecting some underlying risk factor that traditional models are missing? Or are they just statistical artifacts?
This is getting pretty complex. How do researchers even begin to untangle all of this?
Well, one powerful tool they use is something called event studies.
Okay.
These studies examine how stock prices react to specific news or announcements, like a merger, dividend change, or even an earnings surprise.
So you can actually see how quickly the market incorporates new information.
Yes.
And whether there are any systematic delays or overreactions.
Exactly. And the creation of the CRSP database, which tracks daily stock returns going back decades,
Right.
has been a game changer for this type of research.
So what have we learned from all these event studies?
Well,
Do they provide support for market efficiency?
for the most part, yes. The key finding from event studies is that prices generally adjust remarkably quickly to new information,
Okay.
often within a day or two of an announcement.
Mm-hmm.
This suggests that the market is pretty efficient at incorporating company-specific news.
But even if prices adjust quickly on average, aren't there still individual cases where the market might overreact or underreact to news?
That's a great point.
Yeah.
And it highlights an important caveat about event studies. They tend to focus on the average reaction to news. There's still debate about whether some of the remaining price volatility after an announcement is due to rational factors, like differences in investor interpretation of the news, or whether there's still some element of irrationality at play.
So even in the short term, where market efficiency seems to hold up pretty well,
Yeah,
there are still unanswered questions and areas where we need to dig deeper.
absolutely. And the debate gets even more complex when we start talking about private information.
Okay.
Do certain investors have an edge because they have access to information that the rest of the market doesn't?
Now, that's a question I think everyone wants an answer to. It's like the holy grail of investing.
Right.
Finding that secret source of information that gives you an advantage.
Well, there are certainly well-documented cases where investors have profited from private information.
Yeah.
Think about specialists on exchanges who used to have privileged access to order flow, as shown by Naderhofer and Osborne back in 1966.
They could see the buy and sell orders coming in, so they had a better sense of where prices were headed. Right?
Exactly. And then there's the classic case of corporate insiders,
Right.
who legally or illegally use their knowledge of company affairs to profit in the stock market.
Mm-hmm.
Jaffe in 1974 and Sehun in 1986 provided compelling evidence of this insider advantage.
But what about those professional investors, the mutual fund managers and hedge fund gurus? Do they have any special insights that give them an edge?
That's a question that has generated endless debate and a mountain of research. Early studies like Jensen's work in 1968 and 1969 found no evidence that mutual fund managers as a group were outperforming the market after accounting for their fees.
So much for those stock-picking wizards.
Well, not so fast.
Okay.
Later studies painted a more nuanced picture. Some, like Ippolito's research in 1989, suggested that some managers do have the skill to beat the market.
Okay.
But others, like Brinson, Hood, and Biebauer in 1986, and a more recent study by Elton, Gruber, Doss, and Schklarka in 1991, found that mutual funds, on average, underperform the market, especially after accounting for fees and using more sophisticated benchmarks.
It sounds like the jury's still out on whether active management truly adds value.
Yeah.
But isn't it possible that even if the average fund manager doesn't outperform,
Right.
there are still a few exceptional ones who consistently find those hidden gems?
That's certainly a possibility, but it raises the question of how you identify those truly skilled managers in advance.
Yeah.
And it highlights a crucial point. Measuring investment performance accurately is a complex endeavor.
Okay.
The choice of benchmark and the time period you analyze can significantly influence the results.
So it's not as simple as just looking at a fund's past returns and declaring them a winner or a loser.
Exactly. And this complexity ties back to the joint hypothesis problem we discussed earlier.
Right.
When we evaluate investment performance,
Yeah.
we're implicitly making assumptions about how asset prices should behave. If our assumptions are wrong,
Yeah.
our conclusions about performance could be misleading.
This whole efficient markets thing is like peeling an onion. The more we learn,
Yeah.
the more layers of complexity we uncover.
That's a great analogy. And speaking of uncovering layers, there's
Yeah.
one more intriguing piece of the puzzle I want to share with you.
Okay.
Something called the value line enigma.
Value line enigma. That sounds mysterious. What's that all about?
Value Line is an investment research firm that's been around for decades.
Okay.
They're known for publishing these stock rankings,
Mm-hmm.
where they rate stocks on their timeliness,
Right.
essentially their expected performance over the next 6 to 12 months.
So their analysts are trying to predict which stocks will do well in the near future.
Right.
That sounds like a direct challenge to market efficiency, doesn't it?
It does, and that's why it's called an enigma. Back in 1985, a researcher named Stephen Stickle found that Value Line's rankings actually had some predictive power, especially for smaller stocks. He discovered that when Value Line changed its ranking for a stock, the price tended to move in the direction of that change, even after accounting for other factors.
So their rankings were actually influencing market prices.
Yeah.
Does that mean they had some secret source of information that wasn't already reflected in the market?
That's one possible interpretation.
Okay.
Stickle himself attributed the Value Line effect to the fact that information costs are higher for smaller companies.
Right.
So any publicly available insights,
Yeah.
like Value Line's rankings, would have a greater impact on their prices. It's like shining a light on a corner of the market that was previously in the shadows.
So maybe market efficiency doesn't apply equally to all corners of the market.
That's a very interesting question, and it leads us to the broader concept of noisy rational expectations,
Okay.
proposed by Grossman and Stiglitz in 1980.
Mm-hmm.
This theory suggests that because gathering information is costly,
Yeah.
investors who put in the effort to uncover valuable insights are rewarded for their diligence.
It's like a reward for doing your homework.
Exactly. But even with the intriguing evidence from the Value Line enigma, we have to be cautious about drawing sweeping conclusions.
Right.
It's just one piece of the puzzle,
Right.
and there's always the possibility that other factors were at play.
So where does all of this leave us? Are markets efficient or not? It seems like we've uncovered more questions than answers.
You're right. It's a complex and constantly evolving debate,
Yeah.
but I think we've gained some valuable insights along the way. Shall we wrap up this deep dive by putting all these pieces together?
All right, we've journeyed through market efficiency anomalies and even hints of private information. So after all this, what's the verdict? Are markets efficient or are they just a chaotic mess?
That's the million-dollar question, isn't it? And like most things in finance, the answer is nuanced. We've seen compelling evidence on both sides of the debate.
Well, let's try to untangle this. What are the strongest arguments for market efficiency that we've encountered?
Event studies, without a doubt, provide the most compelling case. The fact that stock prices adjust so quickly to new information, often within a day or two of a company announcement, suggests that the market is remarkably efficient at processing information, at least when it comes to company-specific news.
Okay, but those were short-term events. What about the long-term perspective? That's where those anomalies, those patterns that challenge traditional models really start to make you wonder.
Right, and that's where the debate gets really interesting. When we look at the size effect, the book-to-market effect, the role of dividend yields, and even the Value Line enigma, we have to ask ourselves some tough questions. Are these anomalies signs of genuine market inefficiency mispricings that savvy investors could exploit? Or are they simply telling us that our models of risk and return are too simplistic?
It's like we're trying to solve a giant puzzle, but some of the pieces don't seem to fit quite right.
Exactly. And that pesky joint hypothesis problem is always lurking in the background, reminding us that we can't test market efficiency in isolation. We're always making assumptions about how prices should behave, and those assumptions could be wrong.
So what's the takeaway for you and me, the everyday investors trying to navigate this complex world? Should we just throw in the towel and assume that markets are too unpredictable to beat?
I wouldn't go that far. While the evidence against perfect market efficiency is certainly mounting, it's important to remember that markets, in general, do a pretty good job of incorporating information. The existence of anomalies, even if they persist, doesn't mean that markets are completely irrational or that there's easy money to be made.
But it does suggest that simply throwing darts at a stock table might not be the most effective strategy.
Absolutely. The insights we've gained from studying market efficiency have had a profound impact on how we invest. The rise of index funds and passive investing is a direct result of this research.
So instead of trying to outsmart the market, maybe we should focus on capturing the market's overall return through low-cost index funds.
That's one valid approach, especially for those who don't have the time or expertise to actively research and select individual stocks. But even for those who believe in active management, understanding market efficiency helps us to better evaluate investment strategies and set realistic expectations. It's all about being an informed investor, regardless of your approach.
Informed and perhaps a bit more humble. It seems like the more we learn about markets, the more we realize how much we don't know.
You've hit the nail on the head. And that, I think, is one of the most important lessons from this deep dive. We may never fully solve the mystery of market efficiency, but the quest to understand it continues to yield valuable insights that can help us become better investors.
And speaking of further exploration, let me leave you with a final thought to ponder. We've focused a lot on average market behavior in this deep dive, but what about those times when prices seem completely detached from reality? Those moments of extreme exuberance or fear that drive bubbles and crashes.
Those are the moments that truly test our understanding of markets.
Exactly. How do we identify those moments and what can we learn from them? That's a question worth pondering as you continue your journey through the fascinating world of finance. Thanks for joining us on this deep dive.